When you think about a photograph, like a really striking, beautiful photograph that someone posts online.
Right, yeah. Like on social media.
Exactly. There is this immediate assumption that you are looking at objective reality. You just assume it's the truth.
Oh, for sure. But we all know about the magic of cropping, right?
Right. I mean, you can frame a shot that shows this pristine, perfectly organized mahogany desk with a little cup of artisanal coffee.
And it looks completely effortless and perfect.
Yeah, but what the viewer doesn't see is that, like, exactly 1 inch outside that frame is just a mountain of final notices.
Total disaster zone.
Seriously, like 3 empty pizza boxes and a laundry basket that has been overflowing since Tuesday.
Yeah, it's a managed truth.
Exactly. The photo isn't a lie, strictly speaking, but it is a highly, highly curated version of the truth.
Right, because the person posting that image, they know the exact narrative they want to project. They are actively keeping that laundry basket out of the frame.
Yeah.
So the cropping is this intentional editorial choice.
And you would think that when we leave the messy world of social media and step into the incredibly serious, highly regulated world of corporate finance, that kind of cropping wouldn't be allowed.
You would hope so, yeah.
I mean, you would think financial statements are just pure, unadulterated reality, just dry, unyielding math.
Oh, absolutely not.
Right. As we are going to see today, financial statements have historically been highly curated stories themselves. I mean, companies have been using the accounting equivalent of Instagram filters for decades.
Yeah, just to make their economic reality look a little bit brighter, or sometimes significantly brighter.
Which is wild.
It is, and that is exactly where the standard setters have finally decided to step in. The new framework we are discussing essentially forces the camera to pan out.
To show the whole room.
Exactly, the whole room, laundry basket, and all.
Well, welcome everyone to this custom-tailored deep dive. We're speaking directly to you today.
Yeah, whether you are currently pulling your hair out, cramming for your ACCA Strategic Business Reporting exam.
The infamous SBR paper, yes.
Right. Or, maybe you are simply an insanely curious investor who just wants to understand the hidden mechanics of corporate finance.
Either way, this session is designed perfectly for you. We have a fascinating stack of notes in front of us today, pulled directly from the ACCA SBR framework.
Specifically, we are examining the conceptual and regulatory framework alongside the published company accounts section.
Yeah, but the real focal point here, the big mission for today, is unpacking this massive structural shift.
Right, the revolutionary new presentation rules for the profit or loss statement.
Exactly. We are diving deep into the mechanics of IFRS 18. We're going to explore how income statements are being aggressively restructured into these strict buckets.
And why corporate management teams absolutely love to invent their own custom profit metrics.
Oh, to hide their bad news. Right.
Exactly. And most importantly, for your exam strategy in your portfolio, we're looking at the strict new investor protection rules designed to catch them in the act.
Let's get right into the great shakeup.
So to understand the magnitude of this shakeup, we really have to look at the historical foundation of the profit and loss statement, the P&L.
Right.
Because for a very long time, there was quite a bit of flexibility in how a company could format its performance on that page.
Like they could just kind of decide how it looked.
Pretty much. Management had the discretion to group items in ways they felt best represented the business. But IFRS 18 has fundamentally altered the geography of the P&L. Standard setters have drawn hard, inescapable lines on the page.
Okay, let's unpack this because altering the geography sounds really dramatic for an accounting standard.
It is dramatic, honestly.
What exactly are these new hard lines? Like, how do they change what an investor actually sees on the page?
Well, under IFRS 18, there is now a strict requirement for very specific, non-negotiable subheadings right on the face of the profit and loss statement.
Okay, what are they?
The two most critical ones are operating profit or loss and profit or loss before financing and income tax.
Right.
And by mandating these specific lines, standard setters are basically forcing the entire income statement to be strictly divided into 3 distinct buckets.
Operating, investing, and financing.
Exactly. Operating, investing, and financing. Every single item of income or expense a company generates must now be sorted into one of these 3 clear categories.
I really like this framework because it feels like we are forcing management to clean up a room using a very specific system.
Yeah, That's a good way to look at it.
It's like forcing someone to organize a messy closet into 3 clear bins, right? You've got work clothes, gym clothes, and winter gear.
Yes.
Before, you could just throw everything into the closet, shut the door, and if someone opened it, they'd just see this massive, indistinct pile of fabric.
Just a blur of numbers. Right?
Exactly. But now you have to sort them, so you can no longer hide your dirty gym socks, which in this corporate scenario would be your day-to-day trading losses.
Right, the operational bleeding.
Yeah, you can't hide those gym socks inside the pocket of your winter coat, which would be your financing lines.
What's fascinating here is the historical context that necessitated this specific rule. I mean, standard setters didn't just wake up one day and decide they preferred the aesthetic of 3 buckets.
Right. They had a reason.
They implemented this to kill a very prevalent, very deceptive practice.
Oh, wow.
Yeah. We saw countless examples of companies failing miserably at their core business, like the actual product or service they exist to provide.
Yeah.
But they were using complex financing maneuvers to mask that operational bleeding.
Okay, let's ground that for the listener. Say I'm analyzing a traditional manufacturing firm. They make heavy industrial machinery.
Okay, tractors and stuff.
Yeah, tractors. How would they have hidden a core operational failure using financing before this rule change?
Okay, let's say your industrial machinery firm is being crushed by cheaper overseas competitors.
Makes sense.
Their cost of raw materials is surging, their sales volume is dropping. So the core operation is bleeding cash.
Right. It's a disaster.
It is. In the old flexible P&L days, to avoid showing investors a glaring multi-million-dollar operating loss, the Treasury Department might step in.
Wait, the Treasury Department?
Yeah. They might engage in sophisticated financing activities. They might execute favorable interest rate swaps or play the foreign exchange markets using derivatives.
Oh, I see.
And let's say they happen to score a massive gain on those trades that year.
Right, and because the rules around the presentation of the P&L were looser, they would just aggregate those treasury gains with their operational manufacturing number.
Exactly. They just mash them together.
And they produce a net positive result that looks at first glance like the company had a solid year.
That is the core issue right there. The investor looks at the bottom line and sees a profit.
And they assume the machinery business is healthy.
Right. They assume they sold a ton of tractors. They don't realize that the profit came from a lucky bet on foreign exchange rates by the Treasury Department.
Wow.
The core business is dying, but the financing gains are masking the scent.
That is a massive blind spot for a retail investor. I mean, if I'm buying shares in an industrial machinery company, I am doing it because I believe in their manufacturing pipeline.
Right. You want to invest in tractors.
Exactly. If I wanted to invest in a team that trades currency derivatives, I would have just invested in a macro hedge fund.
Exactly. Which ties directly into the conceptual framework's core mandate.
Okay.
The framework explicitly states that the objective of financial reporting is to provide information that is useful to existing and potential investors in making decisions.
Makes sense.
But if you cannot isolate the true operating profit because it's entangled with financing and investing gains, the information simply isn't useful.
It's just noise.
It lacks the fundamental qualitative characteristic of faithful representation. It's neutral. It's heavily biased to make management look competent.
So, by forcing the operating profit or loss subtotal to sit alone, completely isolated in its own bucket, IFRS 18 just strips away that financing camouflage.
Yes. The dirty gym socks are sitting right there in the operating bin for everyone to see.
If you are losing money manufacturing machinery, there is nowhere left to hide it on the face of the P&L.
Nowhere.
And standard setters took it a step further regarding operating expenses too, right? Like they can't just be shoved into a dense footnote at the back of the annual report anymore.
Correct. The mandate requires that operating expenses must be analyzed directly on the face of the P&L.
Right there on the front page.
Right there. Categorized either by function, such as distribution costs or administrative expenses, or by their nature.
Nature meaning like raw material purchases or staff costs?
Exactly. It requires a level of upfront transparency that forces management to show exactly where the operating cash is burning.
All right, so we've established the new geography. We have our 3 strict buckets: operating, investing, and financing.
Right.
But, that naturally leads to a structural loophole.
Oh, how so?
Well, even if a company is forced to use these buckets, what's stopping them from putting really vague, confusing labels on the individual line items they drop inside those buckets?
Standard setters anticipated that exact behavior. Which brings us to the next major shift in the regulatory framework.
Oh, okay.
They didn't just change the buckets. They actively banned vague terminology. Specifically, IFRS 18 strongly discourages the use of the word other.
The word other, you mean like line items that say other income or other operating expenses?
Yes, for decades, the other line item was the accounting equivalent of a junk drawer in your kitchen.
Oh, I know the junk drawer.
Right, you have a random Allen wrench, a broken rubber band, a dead battery. What do? Throw it in the junk drawer.
Exactly.
Well, companies were doing this with millions, and in some massive conglomerates, billions of dollars.
Billions. Just in other...
Yes, they would just lump an enormous variety of distinct transactions into a single line labeled other expenses.
Let me push back on this a little bit from a practical standpoint, though. Let's say a massive multinational corporation has like 50 tiny random streams of income.
Okay.
They sublet a tiny office space in Berlin, they sold some scrap metal from a decommissioned factory in Ohio, and they got a minor insurance payout in Tokyo.
Right.
If they are banned from grouping all of that into a single other income line, isn't labeling every single one of those 50 tiny items individually just going to create absolute information overload for the investor?
It's a fair point.
I mean, we'll have a P&L that is 20 pages long.
It is a valid concern, and the conceptual framework does actually account for a cost constraint and the overarching concept of materiality.
Oh, right, materiality.
The regulators aren't demanding a separate line item for a $500 scrap metal sale in a billion-dollar company.
Okay, good.
Materiality dictates that if omitting or misstating the information could reasonably influence the decisions of the primary users, it must be disclosed.
Ah, so it's about impact.
Exactly. The danger of the other label isn't usually the tiny immaterial scrap metal sales. The danger is when companies aggregate significant, strategically distinct items under the other umbrella to deliberately obscure an economic phenomenon.
Ah, so management uses the excuse of avoiding visual clutter to bury things that investors desperately need to know about.
That is the reality of the practice. When significant items are buried in other, investors simply cannot evaluate the stewardship of management.
Right.
I mean, if an analyst sees a massive year-over-year spike in other expenses, how do they model that going forward?
You can't.
Right? Is it a recurring legal settlement? Is it a massive write-down of obsolete inventory because the product team failed? Or is it a regulatory penalty for environmental damage?
You literally have no idea.
You have no idea.
Yeah.
By forcing descriptive labels based on the nature of the item, like changing other assets to rent prepayment, the standard setters are neutralizing a primary weapon of creative accounting.
Because investors cannot measure what management refuses to name. That makes total sense. And speaking of naming things clearly, the notes for this deep dive highlight a very specific rule regarding goodwill.
Yes, goodwill is a big one.
The new framework demands goodwill be shown as an entirely separate line item in the statement of financial position.
It can no longer be bundled up with other intangible assets. It needs its own dedicated spotlight on the balance sheet.
I noticed goodwill was isolated here, and I assume that's because, unlike a tangible asset like a factory or a fleet of trucks, goodwill is incredibly subjective.
Highly subjective.
And highly sensitive to impairment testing. For you listening, goodwill generally arises during an acquisition when a company buys another business for more than the fair value of its identifiable net assets.
Right, the premium.
It's the premium paid for abstract things like brand reputation, synergies, or customer loyalty. So isolating it makes sense, especially in an environment where interest rates rise and those expensive acquisitions start to sour.
That is the exact regulatory rationale. Goodwill is arguably the most subjective number on a balance sheet, and its value can evaporate overnight if the acquired company underperforms its growth projections.
Just vanish.
Yes. So by forcing goodwill out of the broader intangibles bucket, standard setters are providing a highly visible gauge for investors.
Okay.
It serves as a constant, glaring reminder of the capital management has allocated to buy other businesses.
So you can track their success or failure.
Right. When that isolated goodwill line suddenly shrinks due to an impairment charge, the investor immediately knows that management overpaid for a past acquisition.
It's all about removing the shadows. No more hiding goodwill inside a larger bucket.
Exactly.
And standard setters also tighten the cash flow rules to prevent similar games, correct?
The new cash flow classifications are absolute. Under the legacy rules, there was an uncomfortable amount of flexibility in where you could classify certain cash flows, particularly interest and dividends.
What did that lead to?
It led to a total lack of comparability across peers and, frankly, manipulation of operating cash flow metrics.
Oh, of course.
But now, the rules dictate that interest and dividends received must be classified as investing activities.
Okay.
You are receiving a return on capital you have invested. Conversely, interest and dividends paid must be classified as financing activities. You are paying for the cost of financing your operations.
So again, we're locking down the core buckets. You can't just funnel your interest received into your operating cash flows to make your core manufacturing business look like it's generating more organic cash than it actually is.
It all comes back to the qualitative characteristic of comparability. If Company A puts interest received in operating cash flows to boost their numbers, and Company B puts it in investing cash flows, an investor cannot accurately compare their core operating health.
They're looking at apples and oranges.
Right. IFRS 18 ensures that when an investor looks at the operating bucket of two competitors, they're comparing identical economic activities.
Okay, so we've built the three strict buckets on the P&L. We've banned the vague other labels. We've forced goodwill into the light, and we've locked down the cash flow classifications.
Yes.
So the financial statements are finally a pure, unfiltered photograph of reality, right? The standard setters have won the war.
If only it were that simple.
Wait, it's not.
No. While standard setters can mandate the official buckets and ban vague terminology within the audited financial statements, they do not control the entire corporate narrative.
Oh, right, press releases.
Exactly. Companies still issue earnings press releases. They still build glossy slide decks for analyst presentations.
Yeah.
And management teams, driven by bonuses and share prices, still desperately want to tell the absolute best possible version of their financial story.
Here's where it gets really interesting, because if you can't cheat the formal regulated math on the P&L, you just invent entirely new math for the press release.
Which brings us to the wild west of custom metrics,
Yeah.
officially termed in the framework as management performance measures, or MPMs.
Let's define this clearly for you listening. An MPM is a financial measure used in public communications that forms a subtotal in the profit and loss statement, but is not actually required or defined by IFRS.
Right. It's totally made up.
It is a completely custom-built metric. The classic textbook example from our SBR notes is operating profit before restructuring costs.
If we connect this to the bigger picture, you have to ask why companies go through the trouble of inventing their own adjusted profit subtotals.
Why do that?
Well, the formal IFRS operating profit gives the market the true regulated number, so why invent a new one? In almost every case, it is to gloss over one-off ugly events that drag down the bottom line.
It's the Instagram filter applied to corporate finance.
Exactly.
The company takes a picture of their fiscal year. The background of the photo is a total disaster because they had to close 3 underperforming factories, fire 1,000 employees, and pay out a massive severance package.
Yes, those are restructuring costs.
They're ugly, and they drag the official IFRS operating profit down into a massive loss.
A huge loss.
So, management applies the operating profit before restructuring costs filter. They mathematically crop out the messy background, put a warm glow on the remaining numbers, and present this custom metric to the market.
Essentially saying, hey, look, if you completely ignore the expensive disaster that happened over here, our core business is actually doing phenomenally well.
That is so sneaky.
Management will vigorously defend these metrics, of course. They argue that restructuring costs are a one-off event,
Right.
and that excluding them provides investors with a much clearer view of the underlying or recurring performance of the ongoing business.
But at what point does a flattering filter become a complete misrepresentation of reality?
Well, that's a debate.
I mean, if a company has a one-off restructuring cost every single year for 5 consecutive years, it ceases to be a one-off anomaly. It's just a characteristic of a poorly run business that constantly needs fixing.
That is the exact danger regulators are trying to manage. And the problem extends far beyond just restructuring costs. Historically, the market has relied heavily on alternative performance measures, or APMs.
Okay, like what?
The most famous and perhaps infamous of these is EBITDA, earnings before interest, tax, depreciation, and amortization.
Right.
And in some industries like retail or airlines, they use EBITDAR, which additionally strips out rental expenses.
I am so glad we are talking about EBITDA. You hear it constantly on financial news networks, It's treated like the absolute holy grail of corporate valuation.
It is everywhere.
But there is a massive fundamental flaw with how the market interprets EBITDA, isn't there?
There is a severe misconception. Management teams love EBITDA because it removes the impact of arbitrary accounting decisions.
Right, the non-cash stuff.
Exactly. Depreciation and amortization are non-cash expenses. They are accounting estimates of how a fixed asset loses value over time. By stripping those out, along with tax and interest, management frequently presents EBITDA as a pure proxy for the actual cash the business is generating.
But it is definitively not cash flow.
It is absolutely not cash flow, and this is a fatal trap for many investors. A company can boast a massively positive EBITDA trajectory and still file for bankruptcy due to insolvency.
Because EBITDA completely ignores the movement of working capital.
Exactly.
If we go back to our machinery manufacturer, let's say they build $50 million worth of tractors.
Okay.
They aggressively recognize the revenue, and their operating costs look reasonable, so their EBITDA looks spectacular on the press release.
This is great.
But they haven't actually collected the cash from the buyers yet. Or worse, the tractors are just sitting in a warehouse unsold.
Gathering dust.
All of their capital is tied up in unsellable inventory or uncollected receivables. EBITDA doesn't care about that trapped cash, right? It just looks at the earnings snapshot. But the bank that loaned them the money to build the factory definitely cares. If they have no actual liquidity to pay their suppliers or service their debt, they are bankrupt, despite having a beautiful, positive EBITDA.
That is a perfect summation of the working capital trap. You're essentially looking at a mirage of profitability while the company chokes on unpaid invoices.
Wow.
The only true remedy to the working capital illusion is the statement of cash flows. However, IFRS 18 is making a significant shift regarding how earnings themselves are standardized before we even look at cash flows.
Oh, really?
Yes. The standard setters are trying to move the market away from the wild, unregulated variations of EBITDA by introducing a new, strictly defined subtotal called OPDAI.
OPDAI.
Operating profit before depreciation, amortization, and impairment.
OPDAI. It certainly doesn't roll off the tongue quite as well as EBITDA.
It lacks a marketing ring, certainly, but it is infinitely more precise.
Why did they feel the need to create it?
Because companies were inventing wild, custom EBITDA formulas. We saw companies taking standard EBITDA and adding back stock-based compensation.
Which is a real expense.
Yes. Or adding back startup costs for new projects. OPDAI standardizes the formula by starting with the newly defined, highly regulated operating profit bucket we discussed in Section 1.
Right, the clean bin.
Exactly. Starting there and then allowing only the add-back of depreciation, amortization, and impairment. OPDAI provides a standardized earnings measure. It stops management from sneaking in those wild custom add-backs under the guise of standard EBITDA.
Which brings to mind the ultimate historical example of APM abuse.
Oh, I know where you're going with this.
If we want to see why standard setters are terrified of custom metrics, we just have to look at WeWork. Do you remember their infamous metric prior to their failed IPO?
Oh, community-adjusted EBITDA.
Yes.
It is taught in accounting ethics classes as a master class in aggressive financial engineering.
For you listening, this is the perfect case study of the Instagram filter going way too far. WeWork was losing massive amounts of money. To make their impending IPO look attractive, they invented community-adjusted EBITDA.
Right.
They started with their net loss, and then they added back interest, taxes, depreciation, and amortization. But then they kept going. They did. They added back basic, fundamental operating expenses required to run their business. They stripped out the costs of building out their workspaces.
Unbelievable.
And they even stripped out their marketing and administrative expenses. They basically said, if you ignore the cost of the buildings we lease and the cost of finding the customers to put in them, we are highly profitable.
It was a metric that essentially defined profit by excluding the actual cost of doing business.
Just ridiculous.
It was a profound misrepresentation of the economic reality of a real estate company. And it highlights exactly why IFRS 18 and regulatory bodies have to step in. Standardizing earnings with OPDI is one step, but they also have to police the broader use of custom MPMs.
So how does the new framework actually police these custom metrics to protect you, the investor, or, for our SBR candidates? How do you apply this in an exam scenario?
Right, practically speaking.
Because clearly introducing OPAI isn't enough if a company can still blast a press release talking about community-adjusted EBIT.
This brings us to the exam strategy and the core investor protection rules. The regulatory framework recognizes a practical reality. It cannot physically stop a CEO from hyping an adjusted profit figure on an earnings call.
You can't tape their mouth shut.
Exactly. But what it can do is drag those custom metrics out of the shadows and subject them to brutal mandatory scrutiny within the audited financial statements.
How does the framework execute that?
First and foremost, under IFRS 18, if a company uses a management performance measure in its public communications, that measure must now be officially audited and included in a single note within the financial statement.
They audited.
Yes. It can no longer be a back-of-the-napkin calculation cooked up by the investor relations team. The external auditors have to review the metric, verify the mathematical inputs, and confirm it faithfully represents the calculation management claims it does.
That is a massive operational shift. Suddenly, the custom filter has to be vetted by an independent third party.
Furthermore, the notes to the financial statements must explicitly state that the company's custom MPM is not necessarily comparable to another company's MPM.
Oh, a disclaimer.
Yes. Even if two competitors both use the exact phrase adjusted operating profit, the framework forces them to print a disclaimer. We define adjusted differently than our peers. Do not assume these numbers are comparable.
It's literally a warning label on the financials, like on a pack of cigarettes. Warning. This custom metric may be hazardous to your portfolio if compared directly to our competitors.
A very apt analogy. And management must also explicitly explain why this custom metric is actually useful to users.
They have to justify it.
They're forced to provide a written justification for why excluding a specific cost, like a restructuring charge, actually helps the investor understand the ongoing business.
And if their written justification is incredibly weak, like we were trying to justify ignoring rent, the market will see right through the illusion.
Exactly.
But the most powerful tool for SBR students to understand is the reconciliation rule, right?
Yes, the reconciliation rule. If a company publishes a custom MPM, they must clearly, mathematically reconcile it back to the most directly comparable required IFRS subtotal.
Okay.
Usually this means reconciling their shiny adjusted metric back to the true unadjusted operating profit.
This raises an important question, or rather, it forces management to answer an important question. Show us exactly how you manufactured this number.
Yes, show the math.
It's exactly like a math teacher forcing a student to show their homework. You can't just hand in the final answer of $100 million adjusted profit. You have to show the bridge. We started with a true operating loss of $20 million. Then we added back $50 million in restructuring, $40 million in stock-based compensation, and $30 million in impairment to arrive at our magical $100 million.
The reconciliation table strips away the magic trick. It forces the company to list every single ugly item they cropped out of the photo.
Yeah.
If an analyst looks at that reconciliation table and sees that the company is adding back massive recurring operational expenses year after year just to manufacture a positive profit narrative, the illusion shatters instantly.
And for you ACCA SBR candidates listening, this is where the exam application gets highly technical. You don't just add back the raw expense in that reconciliation table, do you?
No, you do not.
You have to account for the tax effect and the non-controlling interest effect of that adjustment. Let's walk through a mini mock scenario to make sure this lands.
That is a critical distinction for the exam. Let's build on your example. Suppose a company has a custom MPM where they exclude a $10 million restructuring cost to make their adjusted profit look better. In the reconciliation table, they show the IFRS profit, and then they add back the restructuring cost. However, that $10 million restructuring cost originally reduced their taxable income. It created a tax shield.
Right, because if you have fewer profits because of the restructuring, you pay less tax to the government.
Precisely.
Yeah.
So if management is pretending that the $10 million restructuring cost never happened to calculate their custom MPM,
then they also have to pretend they didn't get the tax benefit associated with it.
Exactly. The rules require them to disclose the tax effect of the adjustment. If the tax rate is 20%, they must show that adding back the $10 million expense also means removing $2 million of tax benefit. So the net adjustment to the bottom line is only $8 million, not $10 million.
And the same logic applies to non-controlling interests, or NCI.
Yes, it does.
If that restructuring cost happened in a subsidiary where the parent company only owns 80%, the parent company didn't bear the full $10 million burden anyway.
Right. The minority shareholders bore 20% of it.
So when the parent company adds it back for their custom MPM, they must disclose the NCI effect of the adjustment.
This is exactly the kind of nuanced, multi-step calculation an SBR examiner is looking for to prove you understand the mechanics, not just the theory.
It demonstrates a real mastery of how different parts of the group structure and tax framework interact with presentation rules.
Absolutely. And these regulations go beyond just IFRS 18. We also have to integrate the ESMA guidelines.
The European Securities and Markets Authority.
Correct. These guidelines govern alternative performance measures across European markets and add an essential layer of behavioral protection.
Behavioral, like psychology.
Exactly. ESMA requires that APMs must be clearly defined, the method of calculation must be consistent year over year to prevent cherry-picking formulas.
Oh, that makes sense.
And crucially, APMs must not be given misleading prominence over traditional IFRS measures.
Prominence. This is fascinating because it moves from pure math into human psychology. What exactly does prominence mean in an accounting and regulatory context?
Prominence is fundamentally about visual hierarchy and narrative weighting.
Okay.
If a company issues an earnings press release and the headline screams in a massive, bolded 48-point font, record adjusted profit of $500 million,
Yeah.
while the actual audited GAAP-compliant earnings per share is buried on page 3 in an 8-point footnote, that is a blatant violation of ESMA prominence guidelines.
Because regulators know that the average retail investor scrolling on their phone is just going to read the giant headline.
Right.
They'll assume the company is absolutely crushing its targets and execute a buy order, completely missing the dense footnote that reveals the company actually suffered a net loss.
Human behavior is predictably biased toward the most visible information. ESMA Red dictates that you cannot give your custom-filtered metric more visual or narrative weight than the regulated traditional measures.
They have to be visually equal.
The standard IFRS measures must be presented with equal or greater prominence. It forces companies to lead with the cold, hard, audited reality before they are permitted to introduce their optimistic adjusted spin.
So, what does this all mean for the future of financial reporting? Let me play devil's advocate here to wrap this up.
Go ahead.
Even with this incredible regulatory net, even if the MPM is audited, even if there's a mandatory warning label about comparability, even if there's a massive multi-step reconciliation table showing the tax and NCI homework, and even if the font sizes are perfectly identical,
I feel a butt coming.
if a company is allowed to publish these custom metrics at all, aren't retail investors still going to fall for the shiny adjusted numbers over the dense reconciled GAAP math?
It's a real risk.
Human nature desperately wants to believe the good news. Are these protections actually sufficient?
That is the eternal, unresolved debate in financial regulation.
All right.
You cannot legislate away human psychology or confirmation bias.
Right.
Standard setters can mandate unprecedented levels of transparency, but they cannot mandate financial literacy or due diligence.
Yeah, you have to actually read it.
If an investor refuses to read the reconciliation table or fails to understand that EBITDA ignores the working capital cycle, they remain highly vulnerable. Yeah.
The regulatory framework operates on the foundational assumption that the primary users of financial statements are reasonable in their knowledge of business and economic activities.
It's the old adage, right?
Yeah.
You can lead a horse to water, but you can't make it read the footnote on page 42 regarding the tax effect of adding back stock-based compensation.
Very true. The structural protections are there for those willing to utilize them. The reconciliation rule gives the diligent analysts all the raw data they need to systematically dismantle a misleading corporate narrative.
But it requires the user to actively do the work.
It does.
Which is exactly why we do these deep dives. Because true financial literacy isn't just about memorizing how to calculate a gearing ratio. It is essentially learning how to read between the lines of corporate optimism and understand the motivations driving the presentation.
Exactly. When you see a management team aggressively pushing a newly invented adjusted metric, your first instinct shouldn't be to celebrate the high number.
What should it be? Your first instinct must be to ask, what specific economic reality are they trying to exclude from this calculation, and why do they want me to look away from it?
Okay, let's take a breath and recap the incredible technical journey we've been on today.
It's been a lot of ground covered.
We started with the great shakeup, the structural earthquake of IFRS 18. We saw how the P&L was forced into 3 rigid, unyielding buckets: operating, investing, and financing.
Right, no more hiding operational failures by blending them with treasury gains.
We then explored how the standard setters tightened the linguistic rules, actively banning vague jump drawer labels like other income.
And forcing descriptive, transparent terminology based on the nature of the transaction. We also saw goodwill isolated to highlight acquisition performance.
And cash flows from interest and dividends strictly mandated to ensure peer comparability.
From there, we ventured into the wild west of corporate communication. We explored management performance measures.
the custom-adjusted Instagram filters companies use to crop out ugly realities like restructuring costs.
We dissected the WeWork disaster to show how far APMs can be pushed. We clarified why OPDAI was introduced to standardized earnings and discussed the fatal flaw of relying on EBITDA without checking the working capital and the cash flow statement.
And finally, we examined the robust defensive grid standard setters built to protect investors and the core mechanics SBR students need to master.
The requirement that MPMs be audited, the mandatory warning labels, the strict ESMA rules against misleading visual prominence,
And the ultimate weapon of transparency, the reconciliation table that forces management to show their mathematical homework, including the nuanced tax and NCI effects of every single adjustment.
that reconciliation table is everything.
So for you listening, whether you are walking into an exam hall next week to conquer your ACCA papers or logging into your brokerage account to manage your own portfolio, remember this. The next time you read a glossy corporate press release boasting about a record-breaking adjusted operating profit, do not just look at the photo they want you to see.
Immediately start searching for the reconciliation table. Look for the laundry basket just outside the frame.
The absolute truth of a business is rarely found in the bolded headline. It is almost always buried in the reconciliations and the footnotes.
Very true.
And that leaves us with a final, slightly provocative thought to mull over as we close. We've seen how standard setters are forcing this radical, unyielding clarity onto the financial statements.
They are restricting, more than ever before, how companies can visually present their losses and mask their failures. The regulatory walls are closing in on creative accounting.
The operating space for financial engineering is undoubtedly shrinking.
Oh, without a doubt.
So the question you have to ask yourself is this. Will this era of radical transparency actually force corporate management to change their core business behaviors?
That's the million-dollar question.
Will executives start making better, more sustainable operational decisions simply to avoid generating those ugly, unhideable numbers in the first place? Or will they just deploy an army of highly paid accountants and lawyers to find the next generation of loopholes?
Will they simply invent a new kind of complex, off-balance sheet filter that the current IFRS rules haven't even anticipated yet?
History suggests that the cat-and-mouse game between regulators and corporate management is far from over. It never is. Because no matter how strict the rules get, someone will always try to clean up their room by just shoving everything under the bed.
Always.
Thank you for joining us on this deep dive. Keep questioning the numbers, keep looking for the laundry baskets, and we will see you next time.